So you've worked really hard, now you save some money and you're ready to invest in something that is going to pay you back. In this situation, investing in dividend stocks is really powerful because it allows you to receive compensation in two parts. First, the stock price may go up, you can sell it and make a profit. Second, and most importantly, you can receive dividend payments which allow you to have another source of income that you don't have to work for. The question of course becomes, how do you know when it is the right time to buy a particular dividend stock? Hello everyone, my name is Guillermo and I've analyzed over $1 billion in transactions working at one of Canada's largest real estate investment trusts. And in this video, I'm gonna share with you exactly how it is that you can use the dividend discount model so that you can know exactly what is a fair price to pay for a particular dividend stock. Okay, so in order to find the intrinsic value of a dividend stock, you really have to understand the dividend discount model, and for that we have a very specific formula to follow, which you can see on the screen right here. So the way the formula works, and this is the beauty of this, is that it's very simple to follow. The price or the intrinsic value of that particular dividend stock is equal to the dividend, and this includes the expected dividend for one specific year. So right now, let's say that a company is paying like $20 per quarter. You would take that times the number of quarters, and that would give you the annual amount that you would include in this number right here. And then what you would do is divide that number by the difference between the discount rate and the growth rate. The growth rate is what you expect the dividends to grow over a particular period of time, and the discount rate on the other hand is basically asking you what is a reasonable return that you want to make when you make this investment into this particular dividend stock. Okay, so in order for you to understand this concept a lot more easily, we have set up this template right here, which you can see. And what we're gonna do is we're gonna calculate the dividend discount model, or we're gonna calculate the intrinsic value of Apple, only taking the dividend payments that the company makes into account. And this is gonna show you more effectively how it is that you can perform this for yourself for any company that you like. So the first thing that you see on this template is that I'm getting the dividend data for this particular company, which we have as Apple. In order to do that, I'm using Y-Sheets. I highly recommend that you check it out because it allows you to pull dividend data right into your spreadsheet. If you don't use Y-Sheets, you're gonna have to waste a lot of time copy pasting the data for yourself. It's really up to you how you want to do this. So with this, we have all of the dividend data for Apple, and you can see all the different dividend payments that the company has made, the date, as well as some other information like the adjusted date, payment date, declaration date, etc. Here we're gonna focus on the basics. So first we need to find all the different variables to plug into this formula. First we're gonna start with the dividend, and so for that what we're gonna do is you can just get the dividend for the last quarter or the last dividend payment, and in this case basically this is just pulling this value right here. The other way that you could do this, and this is what I recommend if you want to perform this operation, is to use the function that I'm showing you right now. So you just enter dividend, LQ, and this is going to return the latest dividend payment made. And then what we need to do is we're going to take this dividend, extrapolate it for the next 4 quarters, because there's 4 quarters in a given year, and this is gonna give us the dividend amount that we need to plug into the formula. Once you have that, then we just need to find the other variables, which we're gonna do next. The growth rate is a very simple number to calculate. You basically just need to calculate the percentage difference between different dividend payments. So once you have something like this set up, you can just take the percentage difference, which you can calculate using this formula that you can see right here, where you're basically comparing, taking the difference between the latest value minus the previous value and dividing all of that by the previous value. That gives you the percentage change. So as you can see, this calculation is performed for all of this different data right here, and then you can take an average. So for example, right here that you see that we're doing the 5-year dividend growth rate average, which in this case is 6%. I think for Apple this is a reasonable expectation moving forward. However, based on on your own beliefs and based on your own research, you can adjust this to be higher, or you can adjust it to be lower so that your assumptions are more conservative and you can get a more accurate number based on your own preference and your own analysis. So in this case, what this is doing is basically taking the difference between the dividend payments using the percentage change difference formula that I showed you before from now to 5 years ago. And then it's basically taking the average growth over those 5 years, and that gives you this number right here. So now what are we gonna do? If we're gonna calculate the intrinsic value, all we need to do is take this dividend and then divide it, remember, between the difference. So we're just gonna say the difference is now 1 minus the growth rate. So we're gonna leave this for now, but now we're missing the most important part, which is the discount rate that you can see right here. This is the key question. How do you get the discount rate that you want to use? So there's many different ways of answering this, but the short answer is, what return would you like to make by owning this stock? And that comes to your particular preference, but it also comes based on what is available in the market. One of the great references is what you can see right here, which is the US 10-year Treasury yield. This basically means if you were to invest into this particular US bond, how much of a return would you be making per year? Right now, this is at about 4%. You can also compare this with the amount of money that you could get if you put money into a savings account and what rate you would get back from that savings account. So you could use that and say, you know what, this is the number right now, but I want to make 2% more, 3% more. Why? Because this particular stock has more risk than me just leaving the money in the bank. So that really comes down to your own preference. Another thing that you can do for advanced investors is use the weighted average cost of capital. We have videos on our channel that talk about this, but if you want to keep it simple and powerful, this is the way to do it. In our case, the number that we're gonna use is 8%, and the reason why is because Apple has a lot more risk than just investing in a government bond or just leaving the money in a savings account. So for that reason, let's say that in this case I want to do 8%. So I could just enter 8% right here into the formula that we've created, and then this is going to give you the value per share of that particular company. So right now, according just to this specific formula, the price that we would have to pay to make 8% on Apple year after year, not taking account like how much the stock goes up or down over a different period of time, would be $56 per share. If we compare this with the current share price, so let me do that right now using Y-sheets. Right now you can see that the stock price is trading at $191. So this is basically like 4 times the number that we're getting right now, but that's okay because Apple is a company that offers more to you than just a dividend. It also offers you the return of the company doing better and the stock price doing better over time. If you perform this for companies that are kind of more stable and they provide a reasonable dividend that's very consistent over time, you will see that this is a really powerful tool that you can use and add to your arsenal so that you can build that passive income and that passive wealth for yourself. Now, the cool thing with this is obviously that you can make this super dynamic, where I could change the company now to Walmart. All of the data automatically updates for you. Now you have the value here. In this case, you have the value as well, and you can keep doing this for as many companies as you like. Get the value. If the value is favorable, you invest. If it's not favorable, obviously you can just wait, put that on your watch list, and then when is the right time, you can invest. And this is how you have a really good way of investing in dividend stocks. Now you're equipped with some really powerful information that will allow you to invest effectively in dividend stocks and allow you to build wealth for yourself and for your family and those people that you most care about. If you've enjoyed this video, make sure to subscribe and turn on the notification zone so that way you get notified every time we release a new video like this that's gonna allow you to take your investing game to the next level. I'll see you in the next one.